All right, so we've got our recording in progress. As I said, we've got Jason Jacobsohn here today, founder and managing partner of Propellant Ventures. He's going to talk to us today about venture capital. For those that are not aware, of course, please read our disclaimers. We have our disclaimers right here now on the screen. Information presented is for educational purposes only. That's the key element. Options, venture capital, everything that we've discussed here today involve risk and are not suitable for all investors. If you are looking for advice on this, please consult with your financial advisor. And with that, Jason, why don't you take away the screen and you can start right into your presentation and talk to the people that we've got today that are really excited to hear more about what you've got going.
Excellent. Well, thank you, Keith and Option Hotline, for having me as your guest again. Really appreciate it. So today I'm going to tell you more about venture capital and especially the explosive growth opportunities or explosive return opportunities that venture capital can provide for your portfolio and your asset allocation. So I'm going to give you a little bit of background on myself. Those of you that were here last month may have heard this. I'm not going to go over every single logo you see here. What the key takeaway is over really more than 20 years, I've been active in the entrepreneurial and investment space in the Chicago area, which is where I live, but it's also expanded regionally or nationally and globally. But mostly all the work I've done is supporting the ecosystem to connect entrepreneurs to investors, help them raise capital, provide general advisory services. I teach entrepreneurship as well at DePaul University. I've done it in a number of other settings, and I launched Propellant Ventures a few years ago, 3 years ago, and it was a logical next step for me to start the company and to provide funding for early stage businesses. And we do fill a funding gap here in the Midwest region to come and invest earlier than most professional investors invest. And what I mean by professional investors are venture capitalists, dedicated funds, dedicated organizations like that. We come in earlier than most to provide that early stage capital to assist them in actually growing their company and give them that capital as a catalyst to allow them and to help them really to grow their company in a fast way. So venture capital is about fast. And so what I'm going to do is I'm going to talk about the venture capital process. And something here to keep in mind is venture capitalists, and especially our fund, we like to come in early. We like to see explosive growth with these companies. The companies are going to raise multiple rounds of private capital for explosive growth. Ideally, they hit a certain inflection point, and then there may be an exit. So they're at a certain level, they go public, or a company acquires them. And the goal is to find a pretty, we want a big return, a massive return, and that could be 100x, could be 30x, it could be 1,000x. Our goal as venture capitalists is to find these opportunities that can have that explosive return. Now, venture capital, as you probably know, is a portfolio. So some may have the explosive growth, some may not, but the goal is across the life cycle of the fund is to have a nice return for our investors. So the venture capital space historically has had higher returns in the public markets, and there's a lot of information out there, and I'm happy to share that with you afterwards. But specifically today, I'm going to talk about the venture capital process. Each of these points, I'm going to talk about it. So I'm going to mention them now, and then I have a slide for each. So I'm going to talk about deal sourcing, what that looks like. How do venture capitalists deal source? I'm also going to talk about due diligence. Once we find a company that we're interested in, how do we perform due diligence? Then once we decide, hey, this is a company we'd like to invest in, what does term sheet negotiation look like? Or how do you come to terms with, the company you want to invest in? Then I'm going to talk about the investment side of it. Once you decide you want to make the investment, what happens? Then there's post-investment support. Then there's growth and scaling, helping the companies grow and scale, and ultimately an exit and return for the investors. So I'm going to give you some brief information on all that. Happy to answer any questions also afterwards, but just keep your questions top of mind, put them in the chat, the Q&A, wherever you'd like to do it. So deal sourcing, one of the biggest pieces of...
But I was going to say, if you have questions as they go along, please throw them into the chat box for the webinar or the Q&A box. I can help, filter those over to Jason as he's going along and make sure that we get those answered for you either during, after, or extended after via email and everything else. So I would love for all the questions to just get filtered into that chat box or the Q&A. And sorry for interrupting, Jason, but get right back.
Yeah, that's perfect. No, I'm glad. I like to keep this interactive as I go. So deal sourcing is super important. That's one of the measures of as you're evaluating investing in a fund or someone else's opportunities. It's really the sourcing. How do they source? What is their source of good deals? Can they find deals that you can't find? And investors like venture capitalists are professional investors. This is part of their job. So opportunities come a lot of different ways. So it's a personal network. Someone like myself that's been in the space for over 20 years has that network to get regular deal flow. So that's something you want to evaluate with the managing partners. Do they have that network? Can they get the top deals? Do they have access to deals from other investors and other sources? So personal network is super important. And that can come from all areas of business, all areas of life. And then referrals. Are you one of those sources or those trusted individuals that people refer business deals to you? That's super important. Some of the best deals that do get invested in are from those sources, from your network, from the sources. So referrals from other investors, referrals from service providers like accountants, wealth managers, people that work with those type of individuals. And then also being actively involved in the community. So going to different events for entrepreneurs where you're going to meet them, whether it's a pitch event, holding office hours for accelerators, which are startup launch programs. So getting access to the different individuals building companies, and then being visible and vocal in the community, doing some thought leadership. So being on panel discussions, hosting your own events. So doing all those things to be very visible and have the deals come to you. So super important. You have to have a good deal pipeline. And then once you get that, you also you need to have screening and fund criteria. So venture capitalists have their own criteria. So you get all this inflow, but you have to screen it. You're not going to look at everything. You don't have time. You need to focus on those types of companies that are important to what you want to invest in. Every fund has a thesis. And those are the types of deals also you want to refer to the fund. And as an entrepreneur, you want to make sure you're talking to the right funds as well. So every fund is a little bit different, but some have multiple things. Some are more open, but some funds only invest by stage. So there's different stages: seed, pre-seed, Series A, Series B, etc. So they have different stages of the funding cycle and the growth of the company. They have different industries that they look at. So maybe financial services or fintech, education tech, real estate tech. So certain industries they look at, maybe a geographic limitation. Maybe they only invest in the Midwest. Maybe they will invest nationally or internationally or just North America, but you want to make sure that it fits your own criteria as you're looking at opportunities. Also, the team. Team is super important. I'll spend more time on that, but the team is one of the most important pieces before making an investment. There's an old adage, do you bet on the horse or the jockey? Most people would say the jockey, because that is a team. If you have an A team with a B idea, in theory, that A team can make it work. If you have a B team with an A idea, that team may not be equipped to execute and build that into a good opportunity. So, and you can have both. You can bet on the team and the jockey, or the horse and the jockey, but those are things to think about. Market size. Is it a large enough market that there's a big enough opportunity for you to take a small piece of it? Product uniqueness. How is this unique compared to the other competition and whatever else is out there that people are currently doing or not doing? And growth potential. Again, is it a large enough market, and is there go-to-market strategy that shows that the company is really understanding how to take this to the next level? As an investor, you want a company to have a large growth potential, so there is a nice return. Okay, so due diligence is the first piece. So once you decide you want to invest in a company, or I should say, once you're interested in potentially investing in a company, you have to do in-depth research and that's the due diligence. So this is part of the reason you are investing with a venture capital fund, is to have them do professional due diligence and vet the opportunity. Most investors, angel investors, don't have time to do that. So that's a benefit of going with a fund, is to have them do that professional due diligence. So we look at all the information that they have and we go deep into it. We look at their market, what market they're going after, their customers, the size of that market. We will actually ask to talk to some customers, to understand their process and their experience with the company. What did they look at before they decide to work with this company? So it helps get some market intelligence. We also will talk to some of the investors that were into the company before we came in. We also want to look at their go-to-market strategy. Do they understand, or at least have a good plan in place to how to market and sell this to build that high growth business? We look at their product. Is it unique? What's different about it? Some investors dive deep into technology. It just depends how deep they want to go. We always look at their traction. Do they have revenue? Do they have customers? With customers, of course, partners. Have they built the technology? Where are they at in the business life cycle? We look at their business model and their financials. Does their business model make sense? Are they going to break even or become profitable in a certain period? We want to see what that looks like. And then the legal side, again, depending on if you're a lead investor or not, sometimes you dive deeper into legal, but you want to make sure that they're properly incorporated. Delaware C Corp is what VCs invest in. So we want to make sure they're properly incorporated. We may look at their contracts with employees or with customers. So we want to make sure, and all this usually is provided in a data room. The entrepreneurs provide all this information and we look at it and we ask a lot of questions to tell a story. Really, we put together a due diligence report. It tells a story, so we feel like it's an educated decision. Also, the team is super important. We look at the founding team. Are they successful entrepreneurs that built and sold companies prior? Do they have domain expertise? We have no problem investing in a first-time founder, but we like to see if they have domain expertise. Do they have startup experience? Do they have a well-rounded team? Where they have co-founders? What does the team look like? Most companies at the early stage don't have a full team yet. They may have some part-time, a couple full-time people, but we want to see what that team looks like. And if they assembled a board. So the board is where they can fill in some of the gaps of their founding team or their existing team. So we want to see if they've been able to assemble some good people around them. And that's the sign of a good founder also, is finding people that are better or smarter than them in certain areas. And we also want to look at the resiliency or adaptability. If they started in a tough market, have they been able to adjust or adapt to maybe target some other market or offer a new product or service? A lot of companies during the pandemic didn't survive because they were not able to adapt and adjust. I know it wasn't always in their control, but those that survived were able to figure it out. So again, the team is super important. And we actually have a scorecard, and a lot of investors do. We look at 110 or so different metrics across different categories. So the high level due diligence before we even dive deep into it. Term sheet negotiations. Once you decide that you want to invest in a company, then you need to look at figure out what the structure is of the investment. So if you're a lead investor, whoops, I think I lost it. All right, sorry. Okay.
I think you're okay.
Okay, sorry. I think my screen jumped on me. Okay, I'm back. You can see the term sheet negotiations.
Yes.
Okay, perfect. Thank you. So term sheet negotiations. So once you decide you are going to make an investment, you have to figure out the structure. So if you are a lead investor, then you are going to dictate that structure. If you're a follow-on investor or co-investor, you come along with that structure. Regardless of which one you are, there's different structures whether it's a priced round, it's a convertible note, or a safe agreement. So I won't spend too much time on each, but the price round is ultimately what you want, where you get shares in the company right away. But earlier stage companies, usually they're not structured that way. So something called convertible note, where it's a debt instrument that you're loaning the money in theory, but it converts at a certain period once they raise that next round that is price, and then your investment converts into share price, and then you have equity in the company. SAFE is also another instrument like that, but it's not a debt instrument. Happy to answer any questions more about that. There's different reasons for each, but the fact is you figure out the structure, then you figure out the valuation. Most companies at the early stage with have little revenue or pre-revenue don't really have a valuation, but you can structure it with something called the valuation cap, where this is an artificial valuation. Say it's 8 million, but then they raise a priced round where there's actually shares converted at a 10 million valuation. Those early investors then come in at the 8 million valuation. So it's a cap. So you're coming in earlier and you get the benefit from that. If it's a price round, then you have a valuation number. And either, regardless of how those are figured out, there's some negotiation involved in that. And it's really tied to revenue, current capital put in the business, any intellectual property, patents, et cetera, and a little bit like also the future revenue as well. If anyone's watched Shark Tank, those are the kind of negotiations that happen. And again, oh yeah,
you've got some elements here that are actually very similar to options for those that are well versed in the options market. I mean, when you talk about potential for return, that's exactly what an option really is, right? So
yep.
I mean, I think to this point, like what you're talking about really might just be right up the alley of a lot of the investors here, and I'm really excited for them to look at some of these other opportunities earlier on in that company valuation than what we do once they're public market traded stocks. So anyway, sorry, I didn't mean to interrupt. I'll let you get right back into it, but I just wanted to make that kind of point here that it seems like we've got some same explosive return potential here that I think everybody gets excited by. So.
Yeah, no problem. I'm glad you could connect the dots. Absolutely. And so, and depending on the structure, you figure out an equity stake early, or that's later when there's a conversion. There's also investor rights, and that also depends if you're taking equity or if you're the lead investor. There's also something called pro rata rights, where you invest in the early round. You can also invest in the next round and not be diluted, not lose some of your ownership in that company. So, and then governance, maybe you take a board seat depending on who you are as an investor. So all this stuff is in the limited partnership agreement and subscription agreement, which are the documents that we sign, or actually just the subscription agreement that we sign for the companies if we're making the investment. And then there's the legal and financial advisors. Entrepreneurs need to work with an attorney putting all these docs together, and also working with a CFO to help with that as well. And investors also work with attorneys when it makes sense to also look at when there's negotiation, definitely, especially if it's a priced round where there's equity given up right away, we work with attorneys as well. So the attorneys are the ones that negotiate if you have to go that route. So then once you make the investment or decide to make the investment, as I mentioned, there's negotiation that goes back and forth based on the structure of the deal, the rights of the investors. So once the lead investor decides that, everyone else follows. So you agree on the terms, you sign the term sheet, and you wire the money. In money, it can be done pretty quickly. Just the quickest we've ever done it with our fund, and we work with deadlines. It was first call to money wired was under 2 weeks. We had a 2-week window to get in, and we did it. And it was at the end of the year, a couple of years ago. And and so investors can move fast if they need to, but it also depends on the size of the fund, and they have sometimes a lot of layers to get through. We have a nimble, small fund, and we can move quickly, and so which is an advantage to getting money in quicker. So there's post-investment. So there's value add that you as an investor can offer to the portfolio. So one thing in particular, I've spent more than 20 years, as I mentioned before, in this community. So I have a pretty good network of people I can bring into the fold here to help the company. So that is part of the value add investors provide to their portfolio, is access to the network. So we've helped about half of our companies raise additional capital because I spend time building relationships with other investors. You can provide, and that could be, you could open the network to finding talent, to finding strategic advisors, board members, you name it, whatever their need is. If they're open and telling you that, then you can open your network for that. And some investors provide strategic guidance, especially if they take board seats. They're going to be there actively helping the companies when they can. And some may be there just to provide mentorship, where they have regular calls to throw thoughts out and give guidance. And so investors have a vested interest in this for success. So they want to be there to help the portfolio. There's also monitoring and reporting. So the companies should provide updates on a regular basis to the venture fund or to any investor. It could be quarterly, biannually, annually. We then also use that information to report updates to our investors. So we generally do about a quarterly update to our investors on how our companies are doing, good or bad. And then we also provide annual reports on our investors' stake in the fund and how that also translates to the allocation of each of our investments and what the value of those companies are, what their stake of their value is. So if it's gone up in value since they invested. Also, companies have board meetings, and so that's where sometimes the investors are there. And so reporting is super important. It's an important part of this. We need to know how they're doing, and our investors need to know how our portfolio is doing. So super important. And with the SEC has updated some of the guidelines, so there's a little bit more reporting that needs to happen for some funds, and so there's going to be more transparency in the industry going forward with certain types of funds, especially RIAs, the ones that are registered investment advisors. There needs to be more transparency, but it's good for the industry as a whole. And so now there's growth and scaling. So you invest in the company, you have regular updates. You want these businesses to grow quickly and to scale, because it's about a high return. The entrepreneurs know that they're taking money and they know that they're going to have to provide a return at some point. So, companies need to navigate challenges, scale operations, raise additional capital, and expand into new markets. And the funds can help with that through the network and through strategic guidance. So super important. And then after all that, they get to a certain point, it's hopefully there's an exit, right? Not every company is going to have an exit, but you hope they all do. Or if you could have one amazing exit, which pays everyone a nice, handsome return. And so, but the typical exits for a company in the fund is an acquisition, IPO, or secondary sale of shares. Pretty common. IPOs are not happening as much these days, so acquisition generally is more logical. SPACs were also a pretty big deal for a little while. But once an exit happens, there's a potential for pretty high returns. I mean, that's what we're in this business for, is for super high returns. And investors and the fund share in that return, and the timeline varies on companies. You could have so a typical fund timeline is 10 years. You could have an exit in 3 years, you get an exit in 4 or 5, you can have an exit in 10 years. But as these exits happen, you get paid 100% of your portion back for that investment, and because your money's spread out across all the deals, and then the investors, then any profit is 80% goes to the investors, 20% goes to the fund. And so there is an alignment there, but the investors get their portion of money back, and then they get 80% of the profit. If it's a break-even deal, you get your money back, the fund doesn't get anything back. So, but the goal is to have a pretty nice exit by the time you're done the life of the fund. But the goal, again, idea is to get some money back before the life of the fund is up. So just going to quickly end here with a couple examples of major successes. We all know Facebook and Google, but this is what venture capitalists are trying to find. So Google was founded in 2004. Excel Partners invested $12.7 million into the company. At the time, it was worth about $87.5 million. So this was after their founding, but it was in their first year, but they had pretty good valuation right away. 8 years later, they went public at $104 billion valuation. The return for that investor was 1,200 times the investment. So $15 billion return. Pretty incredible, right? I mean, that happens a lot. I mean, it doesn't happen a lot, but it can happen. Those are the significant returns that some investors can have. You got to have good deal flow. You got to get into these deals. Another one is Google, started in 1998. their first investors, one of the first investors, at least in venture capital. They all had angel investors before, but I'm focused on the venture capital. Sequoia Capital, big firm out west, invested $25 million at $100 million valuation. 5 years later, the company went public at a $23 billion valuation. The estimated return was 3 to 4 million. It's not public information, but the estimate was 3 to 4 billion for Sequoia Capital. So again, that's what we're looking to find one of these, as they call unicorn, $1 billion valued companies that makes the portfolio multiple times over. So as an investor, we're trying to find these opportunities. And that is all I had here. My contact information is here. I know that Keith and Option Hotline will share that as well if you want to talk more. But I'm going to stop sharing my screen and open up to any questions.
I was going to say, maybe we leave the the email open just to make sure that everybody else can see it. But at the end of the day, I think the biggest questions that I've started seeing here from a few people were, what were the minimum investment requirements for your fund?
Yeah, so our minimum investment requirement is $50,000.
Okay.
So it's just very low for a fund. Most funds, it's 100,000 or 200,000 plus. So it's pretty low. We want to keep it accessible for people.
Gotcha. No, I think that's great. And then, do the investors have to be based here in the United States for, compliance type reasons, or can they be international?
Yeah, they can be international. We have language in our subscription agreement about if you're a non-US investor, that perfectly works fine.
Gotcha. And then I think the final one that I had here was, how many investments do you target for your fund?
Our goal is 20 to 25 for this fund. We've made 9 investments across 6 companies, and our goal is to do 20 to 25 individual companies.
I mean, I think that all sounds excellent. I mean, we've got some great explosive potential return profiles here. I think anybody that is looking for something a little diversified from their normal stock market and options market profiles or portfolios, definitely reach out to Jason. If you have questions, he's got his contact information up right now, Jason at propellant.vc. You always know you can reach out to me, Keith at optionhotline.com, and I can forward you along to Jason. But thank you again, Jason. This has been an excellent presentation, and I'm really looking forward to helping all of our clients, I guess, really find ways to leverage their portfolio. So, yeah.
Thank you for the opportunity to speak to your group.
No, absolutely. We'll have you on again soon, and everybody have a great Wednesday afternoon, and we'll talk to you again soon with our next Option Hotline webinar series.
Okay. Thank you.